Welcome back to the channel. I'm Foreman, and today I'm going to be talking about 3 big investing mistakes that every investor makes. I'm going to be giving you some of my real life examples of this too, just to add value to the video. And if you do believe there's value in this video, then definitely drop one of these, as it is much appreciated and lets all of you know that it's a good video to be getting involved with. So first things first, I've got 3 mistakes all tailored together. Let's go through them all. So what is the first mistake? Well, the first mistake is letting your emotions control your investment strategy. So what is the impact of letting emotions drive investment decisions, and how can it lead to a costly mistake? Well, for example, I find that typically someone that reacts with emotion is someone that's erratic, illogical. They're not thinking clearly, and therefore this leads to a problem because they are buying based on a whim. Now, they might have a certain feeling towards a stock. The stock doesn't share that same feeling towards them. For example, I might hold shares in a company called Games Workshop. I could be a hobbyist and absolutely love the product, but the business itself could be poorly managed. But I don't look at this category because I'm so in love with the quality, or just the immersive universe itself, the intellectual property, that I'm therefore distracted from the actual investment at hand, and therefore I'm using investments to drive this decision. For prime example, I've got a good real life example for you here actually. I had an emotion of fear, the fear of missing out. This is the idea that you see a stock go up in price by quite a significant amount. You look back at the stock price and go, oh wow, if I'd have invested just a month ago, wow, I could have doubled my money. And then you see it keep going up, and suddenly it's like, well, it's going to keep going up. I need to buy now, because if I buy now, I could be making some serious money. So you end up deciding to invest in this stock. You haven't done too much research on it, but hey, look, you've bought shares of this company right now. And guess what? It's gone up a little bit more. Fantastic. You've now just made a 10% return on your investment, and it continues to go up. If only you'd added more money into this investment when you first bought. Okay, well, now you're thinking irrationally and illogically. You're going to end up buying even more because you're panicking. You're like, I need to be buying more right now. And suddenly you've made a 50% return. You've invested even more money. But that's not enough, because you're still reacting with emotion, letting it drive your investment decisions. However, a problem hits. This share price can't sustainably continue to go upwards and upwards non-stop, right? The issue is there's a problem with the share itself. And hey, look, they've issued a profit warning, and now guess what? Shares are falling at a rapid rate, and now you're panicking. Suddenly you're going, oh no, this is really negative. I need to get out of this now. And you're stressing, and everyone else that's doing this is also reacting with that emotion, and it's therefore leading to them losing a lot of money. For example, I've actually invested in a company previously called Argo Blockchain. Now, this is a Bitcoin cryptocurrency miner, and it looked promising. Hey, Bitcoin was rallying in 2021. It looked phenomenal. Everyone was forecasting, oh, Bitcoin could be at 6 figures a coin, and I wanted a slice of that pie. I did not do proper due diligence. I looked at the business, thought I understood it, had a great balance sheet, but they started making some very risky decisions. But hey, shares were going up and then shares were falling down. Well, I had the fear of missing out. I had to be buying, and I was using emotion, which is what led to this costly mistake. I believe in total I ended up losing about 50% in total on this position. And if I'd have just gone a bit more rational, a bit more logical, and gone, okay, this is an investment here. Is it really something logically that's a good investment, or am I seeing the share price go up and I actually need to evaluate the situation with this? The second risk is diversification, lack thereof. So why is diversification important in an investment portfolio, and what are the risks of having a lack of diversification? Well, another one that I've made myself. Diversification is protection against ignorance, as said by Warren Buffett, right? Meaning, well, if I want to get great returns in the markets, I should only buy a handful of stocks, 1, 2, or 3 companies, and therefore my chance for maximum returns is even higher, because only one of those stocks needs to go up 100%, and hey, fantastic, my portfolio has seen a significant push upwards in the right direction. However, it can also go both ways, and this is obviously a concern for investors that they don't realize until it actually happens. Lack of proper diversification can certainly mean that you're going to have extreme volatility in your portfolio. By having a majority of your eggs in one stock or share, let's say 40% of your portfolio in one investment, this is a huge concern, because this one investment could perform poorly. And if it does, for whatever reason, if the financials deteriorate, or if a competitor enters a niche and there's a concern there, well, hey, look, 40% of your portfolio was invested in this stock, and suddenly that 10% drop is a huge financial impact to your overall portfolio returns and is a concern. Therefore, Buying and holding a wider range of stocks and investments seems to be the adaptable approach to be flexible and agile in the markets to ensure that you can still get a good return, but also perhaps remove that downside risk of having one or two shares and being tied to them. For example, a prime example of that is investment in Boohoo. Boohoo at one point in time took up 60, maybe even 70% of my portfolio. In fact, following the pandemic, I think I cut down to just 2 stocks in my portfolio at one time. This was incredibly and unnecessarily risky, and therefore I've paid the consequences for it. You can see here, Boohoo has fallen and fallen and fallen. If I zoom out on the chart here, we can really see that over the last few years, it has dropped by a significant amount. In the last 5 years, it's dropped by 84%, which is huge. If I had done proper risk management and diversified my stocks and shares properly, therefore meaning that, Boohoo had a disciplined percentage allocation in my portfolio of, say, 5%, or maybe even less than that, well, hey, sure, shares of Boohoo could have dropped by 85%, but if it was only 5% of my portfolio, I've lost 4% in total. However, because it was a huge portion of my portfolio, this 73% investment loss is actually a bigger concern because it took up such a large slice of my overall portfolio, and therefore I'm sat on quite a substantial loss relative to the overall portfolio value. And I think this means that I'm down about 45 or 50% overall, all because I didn't diversify and buy different stocks and shares. I think the optimal strategy and approach, and perhaps best practice towards this investment mistake, is doing a core and explore strategy. Now, there was a comment that suggested this, and I love the term. Core and explore, or core and satellite, is the premise where that you invest 80% of your total portfolio value in an index fund, a passive global tracker that follows the global stock market and, invests passively for you. The context or the idea behind this is it's a global fund that is invested in multitudes of companies, hundreds, maybe even thousands of different successful companies across the globe. If there is a significant concern or a reason for this stock or this index fund to drop by more than 50%, you've likely got bigger problems to worry about. And overall, you're betting on the global growth of the world. And hey, hopefully it will grow over time. It should do, right? And therefore you could have 80% there, especially if it was the S&P 500, for example, in which over a 30-year period, on average, the S&P 500 has returned 8% per year. So if we consider that and go, okay, well, if I invest 80% of my money into the S&P 500, the largest 500 companies listed in the United States, by market capitalization or size based on the amount of shares and their value, well, hey, I could invest 80% of that into the S&P 500 and then have a little bit more fun to explore, or call them the satellites, where I could invest 10 to 20% of my portfolio in these more riskier stocks and shares that I could take the attitude of going, okay, I like this company, I'd like to buy some shares of it, but hey, at the end of the day, at least if one of them does poorly, well, you've still got 80% of your portfolio in a firm, secure position, meaning that you're able to defend yourself and remain resilient, and perhaps you wouldn't have lost as much, and hey, you might even be positive overall. Who knows? That might be a bit too ambitious. What is the third mistake then? So, market timing. How does market timing affect investment outcomes? What are the pitfalls of trying to time the market? Market timing seems like the optimum strategy to make money investing in stocks and shares. By market timing, you can analyze and know this stock is going to peak at this price. Then I'm going to sell shares. Once this stock has peaked, I'm then going to wait for it to fall, and then I'm going to buy the dip. I'm going to buy shares at their low. By buying at their low and selling at their high, I can make a fantastic return on investment. And in theory, that sounds great. However, there's a few small caveats with this issue, right? The problem with this is you need to know where the bottom price is and the top price is. And unless you've got a crystal ball, can accurately see the future, you don't have a chance in hell identifying this. Now, you might get lucky once or twice, but if you have done, you're likely very, very rich at the moment, and the common person simply isn't going to be able to do this. This is why the dollar cost averaging approach is preached, in where someone might invest as frequently as they're paid into a diversified global index fund, and therefore not worry about it. If the stocks or the index fund is up, say 5% in the month, great, well, they're going to keep buying more. They've made money on their existing shares of the fund. Oh no, it's down 5%. Well, great, this month they've now gotten more shares for their value of money. Great, so over the longer term, they'll hold a little bit more. Or they've, seen a bit of extra returns. So market timing itself, it sounds great on paper, but logically, you can't predict when a specific stock or share is going to drop. Now, there might be negativity in the press, and it might be about the global economy, right? But okay, the shares or the S&P 500 following this negative press has dropped 5 to 10% Fantastic. But do you buy then? How do you know? What if you buy shares of the S&P 500 when it's down 10%? And hey, guess what? Actually, there's a global recession on the way, and because of that, it's been baked into the share price of the S&P 500, and now it's down a further 20%. Well, now you're sitting on a loss. Do you sell, or is that the bottom? Do you buy more? Because you aren't aware acutely of when the bottom is and when the top will be, this is a very challenging approach to take. Therefore, when they categorize the best performing investors over time, based on the type of person, what kind of profession they worked in, what their activities were, the best performing investor was the one they didn't realize was no longer alive when they did the study. They looked at these investors and said, wow, they've done very well on these investment portfolios. What was their strategy? Oh, well, they were dead. Therefore, they couldn't manage their investment portfolios or react to the news. The idea here being that they didn't try and time the markets. Instead, they've invested their money and let it go for the longer term. That's why the S&P 500 on average generates a return of 8% over a 30-year period. By investing for the longer term, you know that on average, in that longer distance term future, I can achieve this sort of return on average. But if you zoom in and you try and focus on the short term between 1 to 5 years, well, that's where the problems are obviously going to be. If you're looking to buy shares within the mindset of I'm going to buy this week and I'm going to sell it in a few days' time for even more of a price, well, you're effectively gambling. And great, well, you can do some forms of gambling where you have a probability and you have a strike chance, and you know that there's a 23% strike rate by making this investment based on the trends that you've calculated. However, I guarantee you, anyone watching this, a majority of you do not do that. So don't even try to time the market, because it's just not going to go well for you. I personally haven't tried timing the market, although if we again went back to the idea of Boohoo here, I did try and buy shares of Boohoo when they first had their modern day slavery allegations. Shares dropped to about £2.40, so obviously I snapped them up at that point, which felt like I'd timed the market. However, my issue was I didn't sell at the top because I didn't know where the top would be. I thought I was buying a good stock and share, and subsequently, look, the shares deteriorated over time consistently, and I'm now sitting on a huge financial loss in my portfolio, that being a concern. My overall portfolio is still drastically impacted by this one critical mistake. By therefore not adhering to diversification and perhaps allowing emotion to drive my investment strategy, you can see here that I'm down a significant portion of my overall wealth. Despite having some decent performing positions in my portfolio that are up about 20%, I've had a 100% return, 120% return holding a company called Ashton Group. It's not enough to make up for the fact that I didn't have proper diversification and subsequently lost money. I had a very interesting view today. I was writing my most recent Stockwatch report, which is on Boohoo. You can see here my final thoughts. And before I continue, this is completely free. There's a link in the description down below. It's all available on my Patreon. This is a free Boohoo report, so feel free to check this out yourself. I've also got a printed copy here that you could obviously see as well. I prefer to print it out. I think it's nice to read. It's 22 pages in length. But in my final thoughts here at the end, I said, while there is potential for a significant upside in the long term, I prefer to wait for improved financial performance before considering further investment. It's important to note that I'm not advocating onto holding losing positions without reason, as described comically as a rabbit in Lee Freeman Shaw's book, The Art of Execution. Instead, I believe that the fundamentals of Boohoo have aligned with the broader industry and do not warrant an immediate sale of shares. If I were in a position where I did not hold any more Boohoo shares and had available capital, I would consider purchasing some shares, but with a much lower overall exposure than my current 30% holding. The point I'm trying to make here is, if I'm looking at an investment and I'm analyzing this and I'm going, okay, is it worthwhile buying this stock or share? Well, if I didn't hold this stock and I'm looking to buy the dip in one of my investments, perhaps here I'm obviously driven by emotion and I'm panicking a little bit. Well, would I buy logically if I didn't hold any shares of this stock? And what I've kind of realized, and perhaps way too late, is at the current state of Boohoo's fundamentals and financials, I wouldn't buy a position with an exposure as high as it is now in my portfolio, which likely indicates to me that I should probably sell down some of this and take some losses. I'm not going to do that because I'm sticking with the strategy I'd initiated in terms of it's fallen. I've made a mistake in valuation, which is another bigger investing mistake that some investors can make. However, the fundamentals haven't deteriorated at a greater rate than the industry, Therefore, I do not warrant, as I say, the sale of shares. Instead, I'm going to wait for the financials to improve, and that's where I would consider buying more, although I'm not going to because it already represents such a huge portion of the portfolio. And that was my improper risk management and therefore my greatest mistake when investing in the stock market. Now, I hope you enjoyed this video. As I said, this report is absolutely free. Comprehensive stock watch report on Boohoo. If you haven't already, check it out in the link description down below, and go check out my Patreon because I write these reports on a weekly basis. And I really go into depth about the competitive threats, the business model of the company, and significantly their outlook and growth opportunities. There's points where I've looked at these stocks and shares and I've gone, you know what? I'm interested in what Boohoo can do to grow. What's their strategy? Well, I said here that Boohoo can pursue strategic acquisitions and partnerships to enhance its brand portfolio, gain access to new markets, and leverage complementary capabilities. Again, this is something that they've done successfully in the past, but could continue to do so as well. I also highlight the likes of Debenhams, for instance. I've suggested that by the purchase of Debenhams, it could be a driver for growth because they can reach a wider audience. They are able to therefore diversify what they do and change their overall business model. So what they could approach is they could sell not only just clothing, but also the likes of, let's say, a wider range of brands and products. So they could sell homeware, beauty, and other products that are important. So again, this is a valuable stock watch report, so definitely go check that out. Link in the description down below. Thank you for watching. Have a fantastic day, and if you haven't already, definitely click that subscribe button. Peace.